Welcome to the One Hero podcast, where we answer Malaysians' burning questions about personal finance with fact-based answers.
Here's the question. If you have 100 ringgit to put away every month for investing, should you put them in a unit trust where you have a basket of stocks? Or are you actually better off investing in individual companies yourself? Welcome back to the One Hero podcast. Today, we're diving into unit trusts to help you understand what exactly you're buying when you buy a unit trust. What are the advantages and disadvantages of buying unit trusts compared to other means of investments like picking your own stocks or leaving your money in fixed deposits or EPF? If you've been thinking about buying unit trust, then listen up because this episode is for you. Okay, so John, what makes unit trust so popular as an investment product?
It is marketed very, very well. That is
That all?
I think that kind of statement sums up why. You ask anyone in Malaysia, especially working adults that have had an income, they wouldn't know unit trust, but they'll likely know public mutual.
That's true.
Because the way it's marketed, you want to take a guess how many agents does the unit trust industry as a whole has? You want to take a guess?
50,000.
Yeah,
Wow,
50 to
yes.
60,000. Yeah, wild guess.
Wow,
right?
that is still a lot. I thought it would be much lower, actually.
Yeah. I think that in itself, plus the billboards. I mean, the legend of Teh Hong Piao. What else? I think because you see, right? A lot of these unit trust products are also delivered through what we call bank channels. So bank channel means the moment you open an account, they will also try to sell you ancillary products. And unit trust is definitely one of the more popular ones. Yeah. And because of that, I think because of the popularity, the billboarding, people actually kind of like familiarize themselves with all this. And when it is marketed so well, sometimes people don't even understand the structure behind it. And I think that's the part where I really want to start this off first with. I think, yes, public mutual is one of many unit trust companies in Malaysia. And I think all unit trust companies, majority of them form a structure where you pool together money, by individuals, and that money is collectively invested into different asset classes. So maybe first and foremost, maybe I want to ask you, among your friends, Louis, how many of them actually have or bought unit trust before? Just a rough sampling.
90%.
90%, right? Okay. Either through a friend or a family member or a colleague who actually does this. Okay. Now, what's the difference, or what is a unit trust scheme? Is actually it consists of actually 6 items. And I don't want to go too deep, but I think it's important for unit trust holders to understand it. There's 4 governing structures, and actually 2 things that you need to understand, right? So the first part of the structure is this thing called a trust deed. So what does a trust deed just means? It just means there's a legal document to say, hey, someone is managing this structure. There is a certain investment objective. There's a certain type of assets they want to buy. Because unit trust, you can actually buy even just telco stocks or REITs or bonds or a lot of instruments, right? So the trust deed actually explains all this. Okay. The second thing is actually this thing called a trustee. So if you buy into public mutual, there's actually a trustee that oversees public mutual as the fund manager. That's the third pillar. So most of the time, the trustee is this person called Amanah Raya. I don't know if you heard of them.
No,
right? It's big. It's a quasi-government. I can't remember exactly how much they actually overlook, but most of the trustee, one of the larger trustees in Malaysia is this body called Amanah Raya. There's also RHB trustees. So let's just say you are RHB, you become a trustee. So you can become trustee for Afin Huang. You can become trustee for that one. So you're the third party observer, the overview guy. So he is responsible for technically managing the trust, and he's passing the responsibility to manage the fund to the fund manager. Now, I don't want to bog you down with all these technicalities, Louis, and also the audience, but I think it's important to understand who are the parties involved. Will you agree on that, Louis?
Yeah. I think exactly, because when people buy from unit trust, they think, I'm buying from my friend, someone I know, but who actually are you buying from? They don't know this, and I wouldn't know who. So I think it's good to understand, just the details about what's happening behind the scenes, financially speaking.
Correct. So trust deed, the agreement. Trustee, the person responsible for managing the unit trust, the trust structure. The fund manager is the guy buying the stock, okay? And last but not least is the unit holders. So four pillars of the unit trust collective scheme, okay? Then there's two other things that I think as a unit holder you need to understand. One is this thing called the net asset value. So the net asset value is the assets of whatever the unit trust buys minus of the liability, okay? And then you divide that value or the number against the number of units that is being in the unit trust itself. So let's say you got 1 million units, the value of the asset is 100 million, so your NAV is $1. Wait, 100 million, 1 million, 100, correct. Yeah. So this is calculated on a daily basis where the units are actually bought, sold, or reduced or increased, right? And it's only during the business day that you can buy. Usually some NAVs are actually calculated end of day, or there's actually 2 days. So it's not as volatile as liquid as stocks. Stocks every second the price is move, right? NAV is usually calculated end of day. End of day. Okay, all right. So you see today probably 50 cents, end of day probably 60 cents, right? It's not going to be like 60 cents in 5 minutes and then it's 80 cents in because you have to remember, unit trust has collectively a lot of shares inside. So every day there's a calculation to calculate the NAV value. Okay. And the last but not least is distribution. So why distribution is important for you to understand as a unit holder is that there's certain capital gains and there's certain income, let's say dividend or dividend that needs to be distributed in a unit trust, right? These are given to unit holders on a periodic basis based on the number of units. So think of them almost like a share, kind of like, so if you're entitled to 10 cents per share in a stock market, so how many units? 100 units, the dividend distribution or the distribution for the unit trust is based on your number of units, okay? So why is it convenient is because I think a lot of the work is done by the fund manager. You virtually, what do? As a client, you go up, you sign the form, the unit trust agent or the intermediary or whoever sold it to you will take care of everything. You kind of hands off, right? You technically half a year or a year, you get a report. You kind of offload all this to the scheme itself, the unit trust scheme, you see.
So like essentially there's a lot of people involved in managing this fund, right? So in order for people who buy unit trust, so let's say I'm a buyer, to offload this responsibility per se of managing my own funds, I leave it to whoever the fund manager is, right? So I think it's very important, actually, when I think about it, to know who these people are. But most of the time when I see, I mean, I am not a big fan of unit trust, so I don't buy them. But when I see my friends or relatives buy them, I never hear them talk about these things, like who's actually managing the fund, what's happening behind, Most of them, they don't know. They just buy based on, okay, whoever is doing the selling, which normally is the agent.
Yeah. I think you raise a very good point, and I think it warrants also an explanation of who are the parties involved. Okay, so I've spoken about the structure itself. That means the trustee and the fund manager, right? The trustee oversees the unit trust scheme, and then they empower the fund manager to buy and sell, allocate the portfolio, right? But the guy going down a little bit more downstream, the guy who is selling that unit trust to you is likely going to be a bank officer. It's likely going to be an what I call a intermediary, lah, which is bank officer, a unit trust agent, financial planner, whoever, right? But he or she is not managing the fund, So she also he's a distribution agent, for the lack of a better word, and I don't mean this in a condescending manner or anything, but they are distributing the fund on behalf of the unit trust scheme. So the money is then pulled together to the fund manager to buy and sell, but the intermediary has no say or may not even fully understand what the fund manager is buying. You see, there's a gap. Yeah.
Can we say that, okay, it's kind of like a car salesman, right? You're selling the product, but you may not understand, how the design came to be, but you have this product, and when you sell it, you get a commission, basically.
Yes.
You may or may not like the car, you may or may not know what's happening inside the car, but you're out there for that commission. You may or may not, I'm just saying, right?
Spot on.
Some agents don't.
Yeah.
That's very interesting.
Have you seen insurance agents sell insurance, but they themselves don't have a policy?
That I actually have never asked, because I always assume that they would.
You always assume, right? Either that or they have a very, very basic policy and they may not be fully covered, but then they sell the stars and the moons to their clients. So again, it's nothing to do with the product itself or the company. It boils down to the individual again, you see.
Yeah, I think because unit trust, it sounds actually to me, right, little bit more complex as a product compared to stocks itself, If you stocks, you look at that company, but now with the unit trust, you also have to understand the fund managers behind it.
Yes.
How are they picking these? Why are they creating this basket of stocks, right? So which comes to the next point of what are the types of unit trust, and how do they actually pick these themes? In fact, a lot of people who I know, right, who buy unit trust don't know that they are buying different themes of trust. They are buying because someone told them good, this one very good, you see it's gone up, no reason they buy. And then they just DCA every month, put 100 like that, or 1 year 6,000, something like that. But when I ask them, so what exactly is in this basket of stocks? Do you know the companies inside? They say, I don't know.
I love it that you brought up this data point and this case study, because I will start first with what are unit trusts mandated to buy. Actually, they can buy a lot of things. They can buy stocks, is a very popular one, bonds. They can do cash or equivalents. They can even do gold. I've seen some gold. Yeah, right. Unit trust. Real estate obviously is another popular one. Commodities, alternative asset. But alternative asset, I don't think is very popular or even prominent in Malaysia. Most prominent is usually stocks, bonds, and real estate, these three. So it all boils down to the theme or what we call the fund objective. And the fund objective is usually stated in the fund prospectus, usually 200-300 pages. Most people don't read. People don't read. Even the agent also don't read. But actually,
the agent only read the commission slide. Yeah. No, just kidding.
Some. So the fund objective, as you pointed out earlier, is very important, because if your objective is to diversify, I give an example, is to diversify your ringgit holdings. That means you want to have an exposure to, let's say, China or Asian markets or whatever, right? Because you already have some funds invested in Malaysia, then you need to understand the prospectus, or the fund intermediary, the unit trust agent would have to explain what is the fund objective to you, because it's his or her job to read the prospectus and to explain to my client, hey, Mr. So-and-so, you already have 30%, 40%, let's say 60% Malaysian equity exposure. Do you want another 20% in China, or do you want whatever, right? And what you said again earlier is a lot of people buy based on what, this China fund went up, or this Japan, people don't buy Japan most of the time, but this China fund went up, or this US fund went up, right? What's the holding inside? What's the philosophy? What's the benchmark? This is actually very important. Okay. What does benchmark mean? So once you have a fund objective and the theme, you need to benchmark the pool of stocks that this fund is going to buy, usually against an index. So I give you an example. If the unit trust is focused in Malaysia, the index is usually the FTSE Bursa Malaysia KLCI index. Okay, so KLCI index means top 30 market companies by market cap in Malaysia. And then when the fund is like, let's just say a Malaysian focus, I'm not going to name names because if not, they'll say I'm biased again. But let's just say a Malaysian focus fund, they said benchmark against the FBM KLCI, right? What happens? What is the constituents of the FBM KLCI? Banks, majority, GLCs, right? So when you benchmark against that and the KLCI has not been moving anywhere, that means the stocks they buy, right, is going to be largely what we call large cap stocks. The big guys are the PCAMs of this world, the Maybanks, the public banks, and all that kind of thing. Now, if you're buying those companies and these companies already kind of hit like a saturation, it's not going to grow as much. I mean, Maybank, how much can Maybank grow? Unless they go and open branches in Cambodia, which they have, and scale is big, how likely are they going to grow to like double, triple, or even quadruple the size? It's not going to happen, right? So you see, the fund objective is very important for the individual investor to understand, So if you're investing in Malaysia, benchmark against FBM KLCI. FBM KLCI has not been moving anywhere. You move 1%, the fund managers, I already matched the index. 1%, right? Or 2%, you see. You see? So I'm going to share with you a real life case study, and I'm going to blank out the names. But this particular individual, one unit trust agent approached him, he bought, and then that person deactivated his license. And then another new agent came to serve him, right? This new agent bought some duplicate funds that his previous agent has already bought. And yeah, it was quite a sizable portfolio. It's about 300,000 more than 300,000, okay? So when I did an analysis of his unit trust and I did the benchmarking and all that, I said, Mr. So-and-so, right? Hey, do you know you have like 3 duplicate funds? And the best part is the 3 duplicate funds over the past 10 years. You want to take a guess what was their return or not, Louis?
Oh my gosh. Is it a loss?
Luckily not a loss, but it was, I said loss in terms of inflation, right? It was about on average 2.5 to 3%. And this money, if you kept at EPF, it's technically a loss. It's not small money, Louis.
It is a loss. I mean, we'll get to it. There's also the fees, etc. It's
correct,
a loss.
Correct. Yeah. So yeah. I'm trying to anchor around the part about the theme and the objective, like what you asked. So obviously he was not aware, he was not educated by the intermediary about what is the objective of the fund, what is the constituents, what is it benchmarked to, So I'm not gonna fire hose the audience here. It's a lot to digest, I understand. But I think most important is like, okay, if an intermediary approach you, and I'm not saying this to say that unit trust is not for everyone. There are people, which we're going to come to later, who unit trust is for. And you have to be honest with yourself. Are you willing to put in the time to study all this? Because if you're not, right, investing something is better than investing nothing, right? So you need to understand what the fund objective is, the benchmarking, before you actually put in money, because you're not putting a small amount of money and the fees are actually quite high as well, quite steep. Yeah.
So I think it's a very interesting point around, like, again, the complexity of this product that a lot of people don't realize. They think that it is similar to a savings account.
Yeah, exactly.
The term that I always hear from people who buy unit trust is that, it's for savings. At least I'm putting it away in a unit trust. Well, I think that is quite true. I mean, that's the reason why EPF exists, or any kind of retirement funds in the world, pension funds. But if you're not careful and you choose a theme that is actually saturated or is on a downtrend, your money may actually go down, right? The value of the money you put inside, like there are some people who have lost half of their money in unit trust.
Yeah.
because of
Yeah.
certain investments in teams or industries that have downturned in the last
Yeah.
5 years.
Exactly. Exactly.
And without them being aware of it, that they are actually invested in that, they've done nothing. And some of them actually asked me, I'm not an investor of that sort, but they've asked me, what should I do, Louis? My unit trust has actually gone down 50%. Should
Wow.
I? Yeah.
Oh my
So
God.
that's what scared me. I'm like, oh, you don't know why it's gone down 50%, by the way. I think with some, I don't know, is it like Malaysian rates or like overseas, but some
Okay.
property fund that's gone down 50%. And they're like, I don't know why it's gone down 50%, I'm like, okay, first of all, right, understand the market that this fund, I mean, they're
I
invested
invested
in.
in
Maybe in that country, this market is not doing very well. I don't know.
Yeah.
And what estates are they invested in? You should know why is it going on. Sometimes there's like a problem with management, a lot of things like that. That how can it have gone down 50%? There's quite a lot.
Yeah.
And if you ask me, right, I would take out that money because firstly, it will make me lose confidence in the fund manager. Yeah. Myself, right? Okay, but you decide yourself. If
Yeah.
you for you, I will also ask you to go just remove the money lah, because you are not studying your fund properly.
Yeah. You might as well put it in fixed D, to be honest. I mean,
Yeah, you fix it, at least the banks have to be held responsible for how they're managing the funds. Even EPF would be better, like
yeah,
investment.
EPF,
At this
yes,
point,
yes.
right?
Yeah.
If you're not willing to go inside, I think that's one of the biggest misconceptions about unit trust. Yeah, that it's a simple product. It's just buy and forget kind of thing.
Yeah, because that's how it's marketed, Louis, and I don't blame them. That's how it's marketed. That's how it's like if you get on board, it's a hassle-free investment for you. And I think that's the mindset that even investors actually do it. And I agree, the product was meant to, I hear some big fund houses CEOs, they said, leave it to the professionals. Yeah, but if we leave it to the professionals, and you don't understand what are the responsibilities, fiduciary duties of the professionals, I think it's a little bit complacent to realize that, hey, it's not nice and dandy. It's not everything is nice and dandy. That's the point I'm trying to make. Yeah.
Mm-hmm. I think as unit trust buyers, if you're thinking about buying unit trust, it's important to understand how the process works at least.
Yes,
So
at
like
least how the basic process works, who is in charge of your money. I think most importantly is the fund objective. Like what you said, down 50%. What is it? Because it was invested in the Chinese property markets when it was at the peak, and then how is the fund manager going to recover from that, or that other kind of thing, right? And again, second thing, to be fair to the fund managers as well, down 50%, but is it within 1 year of a bear market? I think you do need to give time for the fund to actually recover, because investing is not a short game. So instead of just cherry picking, wow, this is during this time it's like so low, whatever, right? I think more importantly is to say, hey, is the fund objective thesis still remain true? You get me? Does it still remain true? Does it still relevant? Yeah.
The scary part is that because they have bought something they didn't understand, right?
Correct.
So they don't understand what to do when this happens, because in their mind it will only go up.
Yeah, it's a straight line going up, right? No. It's not. It's definitely not.
So I think with regards to like types of like trust, definitely like you have all kinds of like themes. Like, so the idea is you need to be careful about what you buy into. But let's zoom into like how actually these stocks are being picked.
Okay.
So we have these fund managers. Who are those fund managers actually? Are they usually qualified? Do they need to qualify for certain criteria?
Yeah, definitely.
So are these guys usually like very trustworthy people, managing the funds? How do they
trustworthy and all? I think it's a very subjective, because there's no benchmarking to say trustworthy or not.
True.
But in terms of the qualification or the regulatory requirements required for them to be a portfolio manager, it's very strict. You need to have SC license. You need to have you need to take several exams, and some of them actually take on what I call industry certifications. So there's one that's very popular. It's called a CFA, Chartered Financial Analyst. So it's actually a very rigorous exam. Only 20% of people who take that actually pass all the way to level 3 actually. So it's quite a high industry standard, but it's not mandatory for you to get your license. So the licensing regime is all done by Securities Commission. There's portfolio manager papers, to advise on equities and all that. I'm not going to go through all that, but once they become a qualified portfolio manager, they can actually pick stocks from a variety of analysis methods. And usually these are the four main ones. I'm not going to list the whole exhaustive list, but these are the four main ones. One is what we call a fundamental analysis. So what does fundamental analysis does? They go and evaluate a company's financial performance, look at the management team, competitive position, the growth. So basically looking at the business. Can this business grow? Are they making money? Are they scaling? Is there growth potential? Do they have good management team and all that? Fundamental analysis. Okay, that's one. Second, and it's only catching up in this region, but it's very popular in the States. It's actually quantitative analysis. So they actually use things like mathematical models. They look at ratios. They look at a lot of quantitative parameters to actually determine to buy or sell a stock. So there's one that is, there's one area in the finance world called quant. And if you look at some of these quant hedge fund managers in the US, they make very high returns, but also very volatile during the bad years, because it's all mathematical model. They don't even care what the business model is. They don't even care who is running it or whatever. They just look at financial models, put it into a machine, usually AI machine learning, and they generate like a buy or sell call, and they trade. Okay, so that's quant. The third is this thing called sector rotation. Now, what does sector rotation mean? 2 years ago, or 3 years ago, I would say, during the height of COVID, glove was all the rage. So everyone will be pouring money into gloves, right? Because it's like going up, right? And then because of that, logistics also took a beating. Not took a beating, was all the rage, because I don't know if you remember, there was a very large container ship that got stuck in the Suez Canal. The Suez Canal, right? This disrupted world trade, logistics prices shot through the roof. Everyone was pumping money into logistics because freight rate just went up. Okay. Then at one time, I think 1.5 years ago, palm oil just went nuts, 6,000 ringgit per ton, right? Metric ton.
Yeah.
Now, these are what we mean by sector rotation. So when there's a catalyst for a sector to do well, let's just say palm oil or oil and gas or semicon, the fund managers actually rotate the fund to ride the trend, to ride this sector rotation. Or the reverse is true, meaning if oil and gas is hot and valuations go very high, the fund managers actually rotate to the sector where no one is looking at because prices have come down. So it cut both ways. Okay, so it really boils down to the mandate or to the direction of where the fund manager wants to go. But obviously the money is, you buy when nobody else is buying, and then you sell when everybody else is selling. Yeah. No, you sell when everybody else is buying. Sorry, the opposite, right? And last but not least is what we call actually it's very related to fundamental analysis. A bottoms-up approach. A bottoms-up approach means you look at company and then you look at industry. Whereas a top-down approach is you look at the economic factors, then you look at what industry is hot, and then you look at the companies. So either way, these are kind of like the four main ways of how stocks are picked: fundamental analysis, quantitative, sector rotation, top-down or bottoms-up. Actually, top-down or bottoms-up is very related to either one or two as well. Yeah.
Yeah, so like just a question, like it seems a bit complicated to understand. For anyone buying a unit trust, do you think it's important for them to know how the fund manager is actually approaching, like picking stocks, investing? Is it important for them to understand like which one of these?
I feel it's important, but also at the same time, they will not be able to narrate all this to you. And even if they try to, it's in a 300-page prospectus, which is like, there's a lot of, not even for example, ESG. environmental, societal, and governance, right? They can narrate that to you, but how do they apply it? What kind of benchmarking do? So I think it's one of the reasons why people stay away is because it's overwhelming. Even me describing to you, right, all this, right, it's like overwhelming, right? And most of the time people say, hey, unit trust, you already take my fees, it's your responsibility, just make my money grow, right? Because they abscond, in a way, they're absconding that responsibility over to the unit trust guy. The struggle is this: even if they write it in a prospectus, even if they write it in a publication, a marketing publication that they tell the investors to, right? Sometimes they may not have the full mandate to be able to perform what they intend to do. And I'll tell you why. And I know you're going to cover this later as well, but I'm just going to give you a brief one now. You see, why do people buy a fund, Louis? What are the usual benchmarks that they will determine? What criteria say, hey, I'm going to buy fund A or fund B, which is A is good or B is better or lousier? You know?
If the interest is higher than FD or like savings,
the performance,
like,
the performance, the yield.
Yield of fund,
Yeah, the yield. So what happens is this: every fund manager, in order to chase the performance or the yields, what happens is they try to chase after stocks, or they try to guess a particular direction, sector rotation, and try to trade. And when you try to trade, right, what happens is usually when you chase, that's where losses occur, because you bet you bet wrong or right. You bet in the wrong direction, and that's why your fund loses money. So in order for them to like try to attract new clients, you have to outperform, right? But it dilutes your long-term goal or anchor of, hey, businesses some year got bad years, some years got good years, ma. This year bad year, be patient, lor, wait for them to recover next year, lor. But then at the back of the mind, it says, hey, if my fund don't do well this year, how am I going to like sell my fund to more people? So there's this tug and tussle. There's this tug and tussle, because when you lose money, investors who are not well, hampered, they will say like, hey, you lost money 10%. You know, I've got some prospects that I'm approaching to manage the money for them for. And what happens is they say, oh, now 5% loss in my unit trust. I said, sister, 5%. or brother, 5% loss in your portfolio is common, it's very normal. But for them, it's like the loss of the world, you know. You see?
Yes, because they are comparing it to the safer instruments, right? What the return of a savings account, a fixed D account.
Correct. And I think that's where that either lack of understanding or not knowing what is the benchmark, it actually is a detriment to the industry, because fund managers they know the psychology of the clients is they're benchmarking against safe instruments. At the same time, they expect outstanding performance. But the underlying things under which this unit trust invested in is they don't even understand that structure, lah. Put it this way, lah. So
yeah, I think it just sounds like, there's this expectation and there's this reality. The expectation is that I'm putting money away into something almost as safe like as a fixed D or savings account, but get a little bit more in return.
Correct.
But the reality is that they're doing almost the same thing as what stock investors are doing. Or you have money, but these guys who put their money in there are not actually understanding it. So it is like a vicious cycle, it sounds to me.
It is.
Yeah. I think this is like the first and biggest misconception that I found with buyers of unit trust, is that they think it's less risky compared to them putting their money into the market themselves.
Yeah.
What do you think about this? Like, is it true? Is it not true? Are you in that position to agree with this statement? Is it riskier or less risky?
Okay. So I'm going to answer again. I'm very sure I'm going to get brickbats for this. So I'm going to answer in tears. Okay. Okay. I'll answer it in maybe different categories. To the person who has the time. Okay. Don't talk about skills. Has the time and the commitment to understand what he or she is buying, then I don't think unit trust is for them. But to the everyday man who has completely no interest in wanting to understand any investment at all, be it property, be it whatsoever. Remember, no one's putting a gun to your head. It's your choice. And I'm not saying that you have to be like super enthusiastic about stocks whatsoever. Everybody's temperament is different. So that's why the answer has to be catered for different people. For people who know what they're doing, have interests, continue building up skills, unit trust is definitely not for them. But if you want something simple, you want to take your hands off and you abscond your responsibility to managing money and all that, unit trust can be a vehicle for them if done correctly. And then third is that if you are just starting out, don't know what to do, I highly encourage you to start. Why? Because only when you put money onto it, then you understand how it works. You know, ironically, sometimes to understand how it works, you must suffer some losses. That is the
True.
wake up call. That's the a lot of people think that the expectation, the moment they put in money, capital must be guaranteed and then there's upside. In the
True.
world, there's no such thing as free lunch. Then they default to the safest, which is fixed D. And then when you default to the safest, which is fixed D, and then they complain, so low interest rate. Hey, hello. This is understanding of asset class, you need to understand risk. You cannot be making money without taking some risk one. The problem is most people don't understand how to classify risk, don't understand risk in itself. That's why, back to your question of whether is unit trust for you or not, I wouldn't say a direct yes or no. Qualify yourself first. If you're the kind of person who wants to grow, wants to learn whatsoever, I don't think unit trust is for you. But if you're the person, hey, I want to abscond everything, go for the stashaways, go for the unit trust, go for the ETFs, all right, which we can talk about later. But again, there's no binary answer. A lot of people, especially people who do not want to spend the time to learn all this, they want binary answers. But how can the answer be binary if you haven't evaluated yourself?
That's true. That's true. I think understanding ourselves, where we stand in terms of how much we want to commit into studying, right, is one thing. And then secondly, our own risk appetite is important. Yeah. But I mean, for those who actually decide to buy it, what's the biggest risk for you? Do you think is from buying
unit trust, right? Yeah. I think it's a few things. One is diversification. Ironically, people say there's an advantage. I think it's actually a disadvantage, and I'll tell you why. Diversification in an advantage is that the more you diversify, the less volatile your unit trust portfolio will be. Because let's just say you have 100 ringgit, you spread it to 100 stocks, okay? Out of the 100 stocks, let's just say 20 of them fail big time. That means they go to zero, which is not to say improbable, but less likely to happen. But that only constitutes 20% of your portfolio. That means all 20 out of the 100 companies, 20 companies went to zero. You just lost 20% only. But because of that, if out of your 100 stocks, only 20 stocks actually made 100%, right? You only made 20% also only. You see, because you're so diversified, you're so thinly spread out to everything, then that's also a disadvantage, an advantage. Okay. Next thing I think is that a lot of things are beyond your control, because unit trust, you're handing it over to the fund manager, to the intermediary. You can't instruct them to buy yourself. So you're absconding control. So let's just say you work for the milk industry, for example, and milk is getting more and more popular, but the unit trust guys are not buying any milk companies, which is right under your noses because you work for the milk company, right? So it's out of your control. Whereas stocks, you are completely in control. You can choose, you can select, right? The third thing in terms of risk, I think, is really fees, because I know most people are unaware. I think 95% of people that I talk to when they invest in unit trust, they actually don't understand the fee structure. So I'm going to explain very basically. It doesn't run very far away anywhere in the world. Actually, there's usually 2 to 3 fees associated with fund management. The first fee is usually what we call either a sales fee or a service fee. But regardless of what you call it, the aim of this fee is actually distribution cost. So what do I mean by distribution cost? They need to pay a unit trust agent or a financial planner or something to distribute the funds for them. So this service fee or sales charge or whatever you call it, for me, is distribution cost. It ranges anywhere between 0, okay, to all the way. The highest I've seen is actually 6%. So you
Wow,
think
that is quite a lot.
yeah. Actually, you'll be surprised. The largest unit trust company in Malaysia charges about 5.5.
Wow.
Yeah.
That's already beating like EPF's return somewhat.
So you're breaking EPF. So the moment you put $100, right, 5 ringgit 50 cent is already taken out before you even put money into the fund. Now, obviously, I believe in a zero fee model, but the thing is, you have to think of them on the other side. For a fund management company, if you put 0, who's going to distribute for you? Are you going to spend? That means you're going to spend money on marketing, sales, promoting, social media, all this kind of thing to actually bring in the money lah. Because if you don't bring in the money, you have other costs to pay for. You're not going to go to a fund size, then you struggle as well lah. So I'm just putting 2 sides of the coin. I'm not just say fees is bad. Yes, fees is bad, but you have to understand the other side that they need someone to distribute the fund. Okay, so that's the first fee. The second fee is a recurring fee. That is usually one-off. The second fee is actually a recurring fee. The recurring fee is what we call an asset under management fee, or usually lumped together with a management expense ratio. Now, what does that mean? This fee is usually used to pay the salary of the fund manager, transaction costs, compliance costs, to administer the fund. And it ranges anywhere. I've seen some hedge funds, some boutique funds charge 0, and they charge the rest all in the third fee, which I'm going to come to. But most common, I would say 95% will charge anywhere between 1 to 2% asset under management. So this is a recurring fee. Every year, they'll charge you 1% of the size of your portfolio. If you put 100,000, then they'll charge you 1,000 ringgit a year. Actually, if you think about it, 1,000 ringgit a year for 100,000, right, it's actually not a lot, 1%.
Yeah.
You're talking about 1,000, you divide by 12, you're talking about less than 100 ringgit a month. 80 ringgit a month, somewhere there, right? So the point I'm trying to make is that this is a recurring fee. And if the fund doesn't perform, this recurring fee is actually a burden because it's taking away even though you have losses. You think about it, right? Every year you're being charged 1%, 1.5, 1.8, regardless, right? But at the same time, if there's losses, then this fee still has to be paid as well. Okay. So the third fee is usually what we call a performance fee. Now, most unit trusts don't have performance fee. So they'll lump the performance with the asset under management fee. That's why some of the unit trusts will actually charge anywhere between 1.5 to 1.8. I think 2 is very high. Anything above 1.8 per year for me is very, very high. Okay. And some companies or some fund houses, what they do is instead of charging the full 1.8 or 1.5, they charge somewhere between 1 to 1.2%. And the other remaining fee difference to 1.8 or 0.6 is actually they set in this thing called performance fee. So what does a performance fee entail? It entails that say, hey, if I do not make a certain percentage for you, let's say 4% or 3%, right, which is like fixed D rate. If I cannot even beat fixed D, technically the client should not be paying for performance, 0.
Okay.
You see where I'm coming from? That means instead of you paying just recurring 1.8, right? They said, no, you pay me 1, but for me to get the additional 0.5 or 0.6 or 0.8, I have to make sure the fund performs for you. Only then I get money.
Sounds fair. Sounds fair.
Sounds fair, right?
Mm.
But most unit trusts, they don't have performance. They just charge a fixed 1.5, 1.8, sometimes 2% upfront. So whether you make money, so the joke we used to have, right, among those fundamentalists, right, we say the fund managers are paid to breathe.
That's true. That's true. I mean, if it's not tied to performance, right, it does sound like that, lah. But I'm sure that there's a lot more nuance around it.
Of
but
course,
it
there's a
sounds-
lot more nuance. It's just a joke, and it's not meant to
Yeah.
condescend fund managers. But the structure is kind of like you're paid to breathe, right? Okay, because whether you make money, you don't make money, hey, you get paid 1.8 right now.
Mm.
So why is fee a detriment to the unit trust structure? Is that there was this guy, God bless his soul, he passed away. His name is Jack Bogle. Okay, if he is actually the father of low cost index funds. So he was the founder of Vanguard.
I see. Okay.
So he detested the fund management industry because of all these fees. So obviously, I'm not going to go very deep because he's wrote many books. He's a legend, by the way. And the people who adore him, there's actually a fan name for these people. It's called Bogleheads.
Okay.
Yeah, John Bogle, ma. So Bogleheads, all right. So he wrote, I think 2 or 3 very, very good books, but you can watch him on YouTube as well. So he created an indexing fund, passive investing, where the fund balances based on the constituents of an index. I know there's a lot of nuance there, but long to short, fees actually take up a huge chunk of unit trust. But at the same time, someone needs to be paid to manage the fund. So fee is, in a way, it's both positive and negative, depend on how you structure the fees. You cannot be expecting, even EPF, a lot of people say EPF is free. No. EPF has what we call a management expense ratio. If you dig deep into the EPF report, you will see that their ratio is anyway, if I'm not mistaken, don't quote me on this, anywhere between 0.4 to 0.7 of the total fund size. Because someone needs to pay EPF staff salary, someone needs to pay the fund managers, someone needs to pay operations, all these kind of things, You think the EPF building free? You think sending managers to UK to do due diligence or to Silicon Valley to fund managers, all this free? There's no such thing as free, guys. Come on, just be real, all right? Someone is paying something. It's just that where is it being paid? How knowledgeable are you to determine where is it being paid? Actually, it's all very transparent in EPF. And I did a video on this, Louis, and if I'm not mistaken, the data I had was 2020. It was about 0.4 or 0.5 of the entire fund size. So that means if the fund is 1 trillion, so they take about 400 million to manage. Yeah. Somewhere about there to administer. Yeah.
I mean, it does. I mean, for me, I mean, it's fair. It's fair to pay people to do all of this work.
Correct.
But it comes down to the buyer, right? Do you know that you're paying for this, and
Yes.
do you know what you're buying into? So as long as you know what you're buying into, what are the risks, what are the costs, then it makes sense to buy. I think a lot of people, when they buy a unit trust, they just expect it to do things that maybe is not realistic of any fund which carries equities.
Yes.
Definitely there will be some volatility in some years, right? There's never gonna be an uptrend forever.
Correct. Correct.
Around, just putting it away. I think when you buy unit trust, you also have to have that patience to bear through when the markets are down as well. You have to understand that it's not exactly like an instrument like savings accounts.
Correct. Yeah. Just remember, Louis, just to what your statement just very, very good, because I also realize for the audience out there, one very important thing that I have to add is that the underlying instruments behind unit trusts or behind an ETF is stocks. And the word that you use about volatility, there's no such thing as stock going up in a linear line or a straight line. There's no such thing. Anyone who told you this, they say, hey, but my fixed D every year 3%. Yeah, the asset is different, ma. right? The asset class is different. A bond, hey, yeah, my bond fund every year going 4-5%. Yeah, because you're being paid a fixed coupon rate. So it's actually understanding the underlying instruments or assets underneath this unit trust. Yes,
Yes,
that
have
is
the
very
right
important.
expectations. Have the right.
Correct.
You're
You know,
actually
there are
buying.
some, sorry, there were some people that, my partner and I, because we help manage discretionary accounts, there was actually I would say an advisory firm that actually approached us, and the clients wanted this advisory. We were thinking about JVing and talking about this, right? The clients wanted an instrument that paid fixed 8% returns every year, fixed, capital protected. Okay, capital protected. That means you don't lose your principal. Okay,
Wow.
and then expecting profit sharing anything above the upside of 8%. I look at my partner and we were like, good luck with Bank Negara, because find me an instrument that does that. Even the world's best investor, Warren Buffett, doesn't do that, right? Because it highlights the point I'm trying to make. You're trying to do 8%, right? What kind of instruments can do that? You have to buy some kind of a junk bond, buy a bond in Sri Lanka or bond in that one that gives you even that kind of interest rate. But the probability of them defaulting is much higher than Malaysia or the US. Okay. Secondly, 8% guarantee. If you want to put everything into equities, yes, you may get 20% this year. What about next year? So again, when clients request this, right, they are benchmarking to what? They're benchmarking to Ponzi schemes that are giving them that kind of returns. But they're expecting it to do the same in a regulated, in a legit asset class. So the four of us, when we were having that discussion, we were having a good laugh because expectation versus reality They see some Ponzi schemes giving them 10% return a month, whatever, right? So they go and say, hey, okay lah, you have regulated instruments, I give you 8% lah, that kind of thing. So the benchmarking is like comparing apples to oranges. It's like completely different altogether.
It's not even a fruit they're comparing. It's like a drawing.
Mutant fruit.
Mutant fruit. Oh, okay, yeah. It's definitely, you can't even eat that, because you can eat it for a year, then after a year something bad happens, that kind of thing.
Yes,
so you go back to the turkey problem.
Yeah,
right.
Right.
You're good for a few years, then that's it for you. It's not long term, and you lose your capital along the way.
Exactly.
Right?
Exactly.
So it's interesting. You also mentioned regarding ETFs as also something similar to unit trust. ETFs are much less popular compared to unit trust. My guess is that they're less marketed. But how are they similar, and how
similar
are they
and different? Yeah.
Should people who are unit trust buyers also consider ETFs?
Very good. Remember earlier you asked me about the what are the differences, what are the deficiencies of unit trust? So I mentioned out of your control, liquidity, and also fees, right? Now, Jack Bogle, when he created the index fund, or now we know them as ETFs, his concept was very simple. Buy a basket of stocks that mimic the index of a particular exchange. Now, the concept was fantastic in a country like the US, and I'll tell you why. Yeah, I need to explain these differences first before we dive into the deeper details about the differences. So what does an ETF do? In the US, you buy a basket of stocks mimicking the S&P 500, the Standard & Poor's 500. That means there's a list of 500 companies within that basket of stocks. The beauty about having 500 companies, it comes from a variety of industries. You have industrial stocks, you have banking, you have some consumer goods, everything. 500, very well diversified. And you mentioned earlier about a point in Malaysia is not that popular. Why? If you build a basket of ETF in Malaysia, you're buying 30 companies. A basket of 30 companies, which is the Maybanks, that one, right? And you notice 60% of it is banks. And then some palm oil, okay? Inari used to be, I think they may or may not have fallen off the list, okay? I remember Dialog was one of the smallest one, the one oil and gas player. Sapura used to be on the list. But other than that, a main chunk of it came from banks, GLCs. You see, so the diversification of that does not make it attractive for an ETF investor. Whereas in S&P 500, right, basket of stocks 500, some of these are world leaders in their industry, and then it's very well diversified. That's where that kind of returns attract it to be a very good ETF, right, versus that of Malaysia. The second reason why understanding ETF structure is important is because you do not need an active fund manager to go in and out of the stock. You don't need to do bottoms up. Like, remember earlier you asked me how they pick stocks, right? The 4 fundamental, quantitative, top down, or sectoral rotation. The passive ETF, they actually just need a computer algorithm that says, oh, okay, S&P 500, who's the biggest today? Let's say ExxonMobil or whatever, right? So when ExxonMobil deteriorates or increases in terms of market capitalization, the algorithm just says, hey, okay, S&P grew up by another 20%. So they'll buy more of ExxonMobil, or ExxonMobil reduced by 20%. They will just sell some ExxonMobil to reduce the stake, so that the portfolio allocation just mimics exactly what is the S&P 500. So you don't actually need an active fund manager. So that's why they call it passive investing, because you don't need a full-time. You can have probably one fund manager overseeing many ETFs, because it's all math. It's all just based on the market cap of each of these individual stocks. You see?
So it's already like, yeah, there's already a lot of like rules in place, right?
Correct. Yeah.
If then,
this kind of thing. And then some of them, they say, oh, I do only stocks with ESG. So once ESG, there's a criteria out, right? Tick. These are not meeting, pop, is out of the index. So you follow according to a set of rules. Okay. Now, obviously, here comes the pros and cons. You make money from a stock when you're buying before they get on the index. When they're small, they are before Amazon is where it is today. You ride their wave going up. But the moment it gets on the index, it becomes like an elephant, because it's so big. I'm just using analogies, right? When it's a cheetah, nobody cares about it. It's silent in the hiding, whatever, and it starts running. Only when it starts running, it caught the elephant and become big, right? Then it goes on the index, right? So obviously the returns, the maximum returns are captured when it's a small cheetah running, right? And when it becomes a big elephant, you're expecting not fantastic growth anymore, because they're already so big. Can you imagine, right? You grow 30% of 1 trillion versus 30% of 100 million. Hey, it's a huge difference, okay? Right?
It's almost impossible, I think, at this point right now.
Yeah, exactly.
Unless the population of the world grows by like that much.
Correct. So that's the structure of an ETF. Very passive, rules-based, follow an index. Okay, 90% or more of the ETFs today are done that. Second thing, is not marketed well. That's why a lot of people don't actually buy into them. And it's related to also Malaysia, especially. I think we have less than 40 or 50, definitely less than 50 ETFs in Malaysia. Definitely less than that. And if you follow FBM KLCI, constituents only 30 counters now. The major difference in between an ETF and a unit trust is the unit trust, you are actually buying and selling to the fund management company or the unit trust scheme. So you can't buy a public mutual fund or a Affin Hwang or a principal fund, or you buy principal and then you sell it to public mutual. You can't. Or you buy an Affin and then you sell to principal. You can't, right? But on an and you buy and sell directly to the fund management company. But in an ETF, you can buy from A and sell to C or sell to D, because it's traded like a stock on the exchange. You go in, as long as the stock market is open from 9 to 5, you can click. You don't care who the buyer is. You don't care who the seller. The market determines the price. Okay. Whereas for a unit trust, you buy and sell based on an NAV. You remember net asset value that I told you about?
Yeah.
That NAV, who determines NAV? It's the fund company,
Yeah.
So you are buying and selling based on his price. He determines the price. Obviously, he can't arbitrarily determine the price. because it has to be based on the assets in the fund itself, right? Which is a basket of stocks, all that. But NAV is actually determined by the fund company, right? Cost-wise, ETF, very, very cheap. You buy and sell, it's just your trading fees of the stock. And there is some management expense ratio in an ETF, similar to that of EPF as well, right, inside, but it's definitely much cheaper than the 5.5% sales charge. There's no sales charge because you're buying and selling, right? So you pay brokerage fee like buying a stock. You do not pay an asset under management fee per se every year, but you do have, the fund itself has a management expense ratio within the ETF itself, right? Usually very low lah. You're talking about 0.1 to probably 0.5 lah, kind of range lah. Okay. Last but not least, ETF is much more transparent because the constituents of the ETF, the basket of stocks, everything you know. Whereas unit trust, you wouldn't know until the end of the year. You get a report. You get a report to say, hey, these were the stocks I bought for you at that point of time. Whether let's say they bought in January and then they sold in March, and then in this come December, it's no longer on the list. You will not know that they bought and sold in January to March. You see what I mean? But an ETF is fully transparent to the market, right? What are the constituents, S&P 500, how to do rebalancing, all that is transparent to you. Yeah.
So I mean, what about in terms of the performance of ETFs compared to unit trust? I think this is a key factor, right, determining whether I should divert my funds from unit trust into ETFs if I'm someone who just wants hands-off investments into a basket of stocks. Yeah.
Okay. Again, some unit trust funds, what they do is in order to compare, the cherry pick periods of time. But yeah, they do that. As I know, again, I'm going to get brickbacks, especially from the industry. But what they do is they cherry pick periods where the fund performs well. But if you stretch it over the longest period of time, right? Actually, the S&P 500 is very difficult to beat. It's about 9.8% over, I think, 100 over years. Yeah, as long as the index was started. If you look at it, basket of ETF based on the S&P 500, it's about 9.8% on average, right? There are some years it does better. I can't remember exactly what period, but there was a period that was like crunching in my spreadsheet, right? Over a 10-year period, they did like 14%. Over another 10-year period, they did like 4%. You see? So it depends on what period of time did you take, and the longer, obviously, the better lah. The longer, obviously, the better lah. So, but more importantly is this: what is a realistic return of stocks over the longest period of time? If you can do anywhere between 8 to 15%, is considered very good. Net of fees, net of fees, net of expenses, and net of. If you can do net of inflation, inflation adjusted, if you can do 6% inflation adjusted, that means, let's say if inflation is at 4, you do 6%, that means gross returns are 10%. You're almost like God already over the longest period of time. Serious.
Wow.
Serious.
Okay.
If you read Buffett's letters, right, there's one letter that he wrote, and he said this, and I love this. He said, most businesses over the longest period of time grow anywhere between 8 to 12%. Only very, very little companies over the longest period of time return on investor capital more than 12% a year. So if you are already knowing that businesses can return that, what makes you think that you can actually do 20, 30, 40, 50%? You see where I'm coming from? There's no logical reason, because the underlying instrument for the stock is the business. If the business can only return 8 to 12, and if you're buying the stock with the hope that it's going to return 50% a year, then I would say good luck.
Yeah. So I guess it really depends on the individual which one they should go for.
Yes.
Just ask yourself some questions.
Yes. Obviously, ETF, in terms of fees, everything, Louis, is very cheap. But then you're opening up yourself to what? Forex fluctuation. Because you want to buy S&P 500, you cannot find good Malaysian ETFs, right? So you want to buy a Vanguard S&P 500 or iShares S&P 500. you need to hedge against your currency risk as well. Yeah, that's
Mm.
something that you have to stomach. Obviously, if you bought US dollar at 1 to 3 versus 1 to 4.5 now, you make money. But then what's the risk of you buying now 4.5 and then suddenly US dollar drop to 1 to 3?
Oh, yeah, yeah. So I guess it's also like, John, would you say like it's not really always gonna be like an A or B thing, could be both, right? Like someone could also buy some unit trusts and buy some ETFs as a way of diversifying their portfolio.
Yeah, spot on.
Mm.
And I think if everyone is expecting a binary answer, I think they're missing the whole point. The point is, what is in it for you? How is it like for you? Like, I know Morgan Housel, he wrote this fantastic book called The Psychology of Money. And for him, even though he writes, studies companies and all that for the Motley Fool previously, he said that I enjoy writing, publishing, conceptualizing more than stock picking. So for him, it's very clear, ETFs only, passive, everything into ETF, right? Because he knows it's hard to spot the cheetah before it becomes to elephant, and he doesn't enjoy that thrill. So he is clear. But my question to the audience is, are you clear? What is in it for you? Are you like, for me, I'm clear. I love the chase. I love digging. I love analyzing whatsoever. But that's me. For you, Louis, is that, wow, is this too complicated? I rather do businesses. I rather focus on real estate. Be good at what you're good at. Be good at what you enjoy and all that kind of thing. And then rather than expecting a binary answer, because A and so is doing A, you should do A. No. It boils down to your temperament. I know some property investors that are at the top of the game, they don't understand stocks at all. I know some stocks investors that are so good at the game, they don't really care about properties at all. So, swing your bat when you know that the ball is coming to your favor, put it this way. Yeah.
Yeah. Just I think the thing is, don't buy into things that you don't really understand or have time to look into. And that's one of the big issues. Okay, so I think we shift our next discussion around another very popular savings instrument, which is fixed deposits, right? I think among Malaysians who are thinking about putting their money into unit trusts, we've mentioned this earlier as well, most of them are thinking to get a little bit more than a fixed deposit. Okay, so I think it would be useful for us to compare, okay, in terms of like the fees, the risks, etc., of these two financial instruments. What do you think of the differences? Is it better to who should leave their money in fixed deposit? Who should put their money into unit trust?
Yeah, it's a great question. Even though sometimes I think it's a little bit of an unfair comparison, but let me explain why I think it's an unfair comparison. You see, what is happening when you put money into fixed deposit? You are actually giving the bank a loan so that they can loan your money out, and then you get paid interest on it. That's how I think of it. That's the way I'm wired to think of it. Obviously, what is the risk then? The risk of a bank failing, because if they default, right, then the bank fails. Then in the past, you cannot get back your money, right? But we have this body called PIDM, or Perbadanan Insurance Deposit Malaysia, I think I can't remember what the D, but PIDM, that actually insures you up to 250,000 on whatever money you put into one bank, in case the bank defaults or in case the bank goes bankrupt. So some smart people who want to circumnavigate the law, or like to play to this game, they never put more than 1 million or never put more than 250,000 in one bank. So they have many banks. So because when a bank fails, then 250 will come back, 250. So because it's capped at 250. You get what I mean? But again, I say it's an unfair comparison to unit trust. It's because in a way it's cash. So it's a different asset class altogether, whereas unit trust, ETF, is actually stock. So what does cash actually mean? It's liquid, it's risk-free, and it's also a very, very, very safe instrument. The risk profile is completely different. Okay, the risk profile is actually the bank's assessment and insurance that protects your deposit. Now, the biggest risk to fixed D, for me, is not even that. It's actually inflation.
Right, true.
Because yes, it's very safe. I get 3%. The banks will not go, even if the banks go bankrupt, yes, I get insured up to 250. But hello, if you come to the Klang Valley, you and I know that inflation is definitely more than 3%, right?
Mm.
Food prices going up, toll prices going up, everything is going up. So if you are putting it at 3%, your purchasing power is being eroded every year. I call it the silent risk that nobody really thinks of. It's like the silent killer for heart attack.
Yeah, you pay for it for sure, but you don't really like realize it. It creeps up on you. Yeah.
Yeah, it pays for it in the future. Okay. So when you compare fixed deposit to unit trust and also to ETF, you cannot compare rates because it's not an apple to apple thing. What you should be comparing is what kind of risks are you taking comparatively on the ETF and on the stocks and on the unit trust. So actually Buffett has this rule. It's such a simple rule that not many people understand this. And I actually share this case study with a lot of people. What was, probably you were much younger than Louis. How young were you when it was 1993, 1994?
4 years old.
4 years old, okay.
5 years old, yeah.
Yeah, so you go and ask your mom, what was the fixed D rate in 93, 94, 95? I don't even know. Take a guess. Fixed D rate,
5%.
9 to 10.
9 to 10%.
Understanding history is actually very wonderful, okay? So you ask your mom or your dad, if they were borrowing money to buy properties back then, right? What was the interest rate in the 95, 96? And I lived through that. I was a Form 5 student. After while waiting for my result, I went to work for a factory, okay? And I had colleagues of mine paying housing loan, fixed interest rate, Islamic, 10% interest rates.
Wow.
So we grew up, you and the younger generation grew up in a low interest rate environment, 1%, 2%, that kind of thing. So when I was a teenager, that was the interest rate because the fixed D was giving 8, 9%. So loans will always be higher because banks need to make the spread, correct? Now, what happened was this. Everyone was also making money in the stock market. They joke in the 1990s, you throw money into any stock, you sure make money. Okay. So how is making money in the stock? How is businesses making money in the stock market usually measured? They usually measure it by this thing called earnings per share. So if the stock is $1, the earnings per share is 10 cents. So if you talk about earnings yield is 10%, because 10% over $1 is 10%. Am I making sense so far?
A bit.
A bit, okay.
Yeah, I have to come back to review it later.
Yeah, I have to. Yeah. So how do you benchmark that against fixed D? So company is making profit or earnings yield of 10% against the shares. Okay. Fixed D was 10%. Okay. So between the stock and the fixed D, which is safer?
Fixed D.
Fixed D, right? This one guaranteed I'm going to get my 10%.
Yeah.
But the stock, this year profit, yes, maybe 10%. Next year, don't know. Right? So why is this important for me to explain to you how to measure risk? Is what Buffett calls, when you are taking risks, you have to make sure it's 2 times risk-free rate. Okay, I repeat that. It's 2 times risk-free rate. So what is your risk-free rate in the 1990s? It's 10% or 8%. So you put your money in a safe instrument, guarantee you get 8%. Guaranteed. Protected by insurance some more. But you put your money in the stock market, the businesses, the earnings was only making, let's say, 10%. So was it attractive for you to put money into the stock market? Yes, the share price go up, but the business earnings was only 10%. Whereas here, guaranteed, as long as the bank doesn't go bankrupt, you get your 10%. You see where I'm coming from now? So
does it mean like you have to double that, like the FD
correct.
rate?
So for you to invest in the stock market or the unit trust or whatever equities or stocks, right? You better make sure that the earnings is at least 2 times of the risk-free rate. Because you're taking risk, Here is safe, here is not safe. Now, I give you an example. If fixed D now is like what, 3% or 4? I don't know. 3, I don't have fixed D.
Depends. I think
Normal,
lowest
don't talk about special rate.
yeah, 2 point something also got
Okay, 3 lah. Let's say 3 lah.
also
Math.
3 yeah.
That means when you are going to invest in a stock, the earnings yield that you buy for this particular stock must be at least 6%. It's double that of this particular company. At this particular fixed D. Sorry, risk-free rate. So I know it's a new concept for you, or hopefully the audience too. And I know some of the audience understand this. It's okay. Let me use an example. Another example, property. You buy 100,000 house, and then you rent it a year for, let's say, 10,000 ringgit. Okay, 100,000 property, 10,000 ringgit rent a year, 800 something a month. Okay, what is the rental yield? 10,000 over 100,000. Rental yield.
8%. Sorry.
10,000 over 100,000.
Or 10,000 over 10%. Yeah.
10%. Okay. So if you buy this property and you can get 10,000 rental, your yield is 10%. Okay. Now, if you put money into fixed D, but you're getting 10%, easily the same. Between the rental property and the bank, which one will you go for?
Bank.
Why?
Okay, a few things with the rental property, like the prices may fluctuate, and then there's also the maintenance. Yeah, maintenance. Yeah, tenant problems.
Correct. Yeah. Correct. But here is you're secured. You'll get your 10%. Contract lock in 1 year, you get it.
And it's net already, right? I mean, with the house, with the property, you also have to do fixes, a lot of things plus
Precisely.
other expenses. Yeah. Precisely.
So in order for you to buy into this investment property, you're taking some risk. So when you want to take risk, right, you better make sure it's better than 10%. Because here, safely you can get 10%. Here, I'm taking so much other risk, other hidden costs, flood, natural disaster, so many variables, you see. So when you do comparison, you cannot compare equal to equal. The risk instruments, you have to put a premium. That means they have to give you
whatever we see as like an FD rate, we should at least get like twice as much interest in a unit trust.
Yes, or returns in unit trust or in stocks. You must, because you're taking risk. So that's why when you do investments, right, when interest rates are high, right, and you see the earnings of these companies are lower, might as well put into bonds and stay in cash. Make sure this compounds. And then when the market is pessimistic and then interest rates are low, because market is optimistic and interest rates are low, then the opposite happens. You're paid to take risk. So you switch in between these two, because again, right, the notion of investing is really about understanding risk, understanding what is fair to be paid at a certain point of time, and then you take the risk when your upside is in your favor. Because
so it sounds
really,
it sounds a lot like, okay, again, no binary answer. It really depends, and at this point we also have to be agile, right? In investing, not only like put our money in one place forever.
Correct.
It's actually a very convenient thing to do. Like, okay, like people when they buy unit trust, I think a lot of people imagine themselves putting 100 ringgit, 200 ringgit, 300 ringgit a month for 10 years, 20 years, or forever, as like a separate fund to their savings account, without considering that maybe at some point I should withdraw money, put it somewhere else, or do the same with the FD, right?
Yes. It's you hit the nail on the coffin. Most people just 20 years just set. They're so rigid, but they're not growing. Now let me ask you, do you think billionaires actually buy unit trusts?
I don't think so. I don't
Yeah.
think so. Yeah.
I don't think so too. I mean, if you have access to buy art or watches that gives you a better return, would you not take your money from some FD and move it there? You see where I'm going? So it's a progression. It's not to say that you see, right? If a listener listening to this is like, what is John talking about? All these concepts so alien to me, and then risk-free rate 2 times or whatever. It's just like what I'm saying is start off with unit trust, nothing wrong. Understand the fees. Then are you going to stay there stagnant, or are you going to upgrade yourself to understand more? When you understand more, you start reducing your risk. You start reducing your fees. You start understanding risk better. You start getting into instruments that you understand the risk better, but the rewards are much better. You see where I'm coming from? Like I started off buying unit trust as well. Did I enjoy it? I enjoyed the process of learning, and I understood how fees can be detrimental to me. That's why I upgraded myself. But if you like saying, oh, I want binary answers, good or bad, no, it doesn't work that way. I mean, you can choose to work that way, but you stay stagnant. That's it.
Yeah, and I think it's also quite scary because a lot of people actually set up like auto debits every month from
BCA
their
lah,
account.
because they're being sold sikit-sikit, lama-lama jadi bukit. You cannot time the market, diversify, force savings, all that kind of thing. While that is true to certain extent, I believe the key point is what I'm trying to say is while you are DCAing it, while you are investing, are you upgrading yourself to understand risk reward better? That for me is super key.
There's the opportunity cost that
Correct.
Perhaps on one side you may have this like 10,000 a year saved up in unit trust, but could it have grown to something bigger, like 2 or 3x more, if you had done more research, studied, upgraded yourself as an investor?
Correct. I used to dump a lot of money into my housing loan also. There's something that people tell you, ma. Remember, you have extra money. Oh, why you want to give interest to the bank, whatever? Now, I pay ngam only. Why?
Yes, correct.
Because you have an insurance to protect it. That's way about upgrade. You get a proper insurance, MLTA, to protect your debts with a debt cancellation plan. And then whatever surplus, if you are putting into your loan, what are you saving? You're saving 4% of whatever interest that you're paying, right? But the same money, if you upgraded your skills and knowledge and find the right partners to grow with you, you do 10%, 6% compounding over 10 years is a lot, Louis.
It's a lot.
It's a lot, you know.
And the figures here one day again.
Yeah.
To
but some people say, go ahead. Sorry.
Another, I mean, FDs is one, but another instrument is EPFs. Everyone who's an employee has an EPF, or if you contribute yourself. For those who have an EPF account, Malaysians have the opportunity to withdraw some of that and put it into unit trust. So sometimes when you look at EPF's returns, right, the yield I don't think historically has gone above 7% so far.
No.
This when I look at the last 10 years, it's hovering anywhere between 4 to 6 plus. Right?
Correct.
4 to 6+%. And so some people, when they look at this, they're like, oh, this is quite low. Actually, only a little bit above my FD rate, or maybe same.
Yeah.
What if I move some of that money into unit trust? Would I earn more? So what do you think about this idea around moving funds from EPFs? Should they actually leave their money in EPF?
Again, boils down to you understanding the risk. Like some people I know, they're good at what they do. They understand investments. They actually can buy stocks directly through an EPF account. Obviously, it's not well publicized, but there is actually a scheme where you can use EPF account 1 to buy stocks directly. There's one. But provided they have the necessary skills and understanding, or they have found a right fiduciary partner to help them manage. But most of the time, I would say 90% of people who don't want to get their hands dirty, roll up their sleeve, I think EPF is a wonderful tool, to be honest. Just leave it in there. Rather than you take out, you pay fees, especially to, buying a product like a unit trust or an insurance, whatever, right? How do you know whether he or she and the intermediary that sold it to you will be able to do that fiduciary duty to the utmost maximum, right? And I think that's where the struggle will always come, because it all boils down not to the fiduciary, it all boils down to you. Do you understand what he or she's investing philosophy is? And even if you do, is the intermediary selling to you the person executing this philosophy? If it's not, the fund manager, you don't have access directly to the fund manager. How many do? I mean, you buy a fund, right? If the fund is like 20 billion, I say, I want to speak to the fund manager, and I invested 1,000 ringgit.
Yeah. When I look at it, right, EPF and unit trust, I mean, fundamentally, they're doing almost the same thing, right?
Yes.
They have a basket of stocks, there's a fund manager. And if you are not looking at EPF report, right, and understanding how they're managing the fund, how it works, how do you get this money, where are they investing your money, what would be the benefit of doing the same thing, but now with additional fees?
Correct. That's the spot on, Louis. Yeah, spot on. And I think one more point to add is, if you never understood what EPF is doing with your money, then how are you going to benchmark what other instruments, regardless unit trust, stocks, whatever?
Yeah.
What's the benchmarking?
I think the mistake here is that, again, just looking at some performance information, like historical, maybe not even historical. I think a lot of people, when they look at buying these unit trusts, they don't look at historical performance
Correct.
Even deeper. But now, like, last year we did 12%. Look at EPF, we are doing more than EPF.
Yes.
Double. Our yield is double of EPFs. Oh, okay. So then this person is convinced, and like, okay, I'm gonna transfer this bulk of money into this unit trust. And very interesting, we are doing a lot of TikTok videos right now. And make sure, guys, follow One Hero on TikTok. And what I find that in the comments, there are these like retired individuals who actually did that. They transferred some of their money from EPF into unit trust, and a lot of them reported big losses. Then they say, okay, I really regret doing that, transferring it out. And then some of them actually like sold the unit trust and then transfer back to EPF again. Yeah. So if they could turn back time, I think most of those people who left that comment would not have done that. Yeah. So it's worth considering, what you're doing. Should you actually move it from something like EPF into something you also will never take time to understand? The risk will even grow,
Yeah.
And then on top of that, you're paying them for that.
Correct. Fees and all that. Yeah. So if you don't want to take the risk, just stick it in EPF. No one's putting a gun to your head, right?
Yeah.
But
I mean, don't like buy into the marketing schemes.
Correct.
If you don't take the time to understand, then maybe better.
And I think one more point just to add, right? I'm not saying that all unit trust intermediaries are bad. Don't get me wrong.
Correct.
I've met some very good ones, right?
Correct.
Yeah. And I think it takes two hands to clap. How do you know it's a good one or a bad one? You yourself have to be equipped the knowledge,
Yeah.
Right.
If now you're not reading the reports of EPF, will you read the reports from unit trust? Will you know what questions to ask them?
Correct.
It's almost the same structure.
Yeah. And you see, right, every time I don't think it's also fair to completely blame the unit trust agents who sold them, because what they want to hear, the clients are sometimes they only want to hear what they want to hear, which is like, oh, is it safe? Is it going to give me excellent returns, whatever? So in a way, to make the sale, the unit trust agents sometimes have to like make an unwilling promise, or like to sound nice and to do all that. But I can tell you, if your unit trust advisor or financial planner or whoever is managing, and the client also is in a way well read and open to sharing his belief system, and there's a negotiation that happens, and like, hey, I'm sharing this idea, what's the risk, how do you manage this risk? That's where I think when you take ownership, only then it happens. But if you don't take ownership, don't start blaming the people who will take the fees for you, because there's no such thing as free lunch. I don't think they should have zero fees. Zero fees. There's no economic incentive for people to manage your money. Why would they want to do it for you? I wouldn't do it for free. Will you do? Will you manage 20 billion for free? You know how much stress that comes with, Louis?
Yeah, I mean, the accountability, you have to be the one answerable to all the questions of whoever owns this money, right? So I think only do it if you're willing to take that step to do more work on your part. If you want to just do the same thing as what you're doing with your EPF account, then just leave it in the EPF account.
Yeah, just leave it there. Just leave it there. I mean, they and don't get me wrong, it's not free also. They also pay that.
Not free, of course. But because if you're taking the same attitude, right, it's not gonna benefit you because these people will take a higher fee from you, right?
Yes.
Okay. Yeah. I think we have gone quite a while.
I just one last thing before I end because of EPF. The asset allocation, I think we've covered in either the previous YouTube videos or some of the TikToks, right?
Yeah.
Understand this. You cannot expect EPF to do 20%. Why? Very simple. They have a certain percentage which is in equities, right? 40%. There's a certain percentage in fixed income instruments, or 40% or so. So when you have that kind of allocation, you cannot be expecting EPF to actually give that 10% return for you, right? And similarly, why equities can return is because you're taking more risk. You are not buying your portfolio of some fixed income or some bonds. That's why you can actually have higher gains, but also exposed to the volatility. I actually wanted this as an anchor to kind of make people realize the differences when you're comparing EPF to stocks direct. You have less volatility in EPF because a big chunk of it is fixed income, and you have more volatility in equities. But equities, if you do it right, the upside is higher, but also there's a risk of downside as well. EPF, your upside is pretty much capped, but the downside volatility is lower. So understand that risk management profile.
Yeah. It makes a lot of sense. So just understand the products that you're buying, what asset classes, what are the risk of different asset classes versus their returns. Okay.
Correct.
Their risk, their returns, we already know this.
Yes.
All right. So just to close on this very long already episode, I think it's such a topic that you can go on and on because of just how much misconception is out there and how little people understand about it. And I think that our hope with this episode is that more Malaysians buy into unit trust, understanding what they're buying into. And maybe when you talk to an agent selling the unit trust, you actually ask the right questions to them to understand who's managing the funds, etc. Okay.
Yeah.
So on closing, let's look at one Reddit thread.
Sure.
Okay. Maybe John, you share the Reddit.
Yeah, I will share the Reddit thread.
Yeah, I think we just wanted to bring this Reddit thread into this discussion as a closing because I think that this particular Redditor really pointed out some questions that a lot of Malaysians have when it comes to buying a unit trust for the first time, or even considering investing money outside of your fixed D or savings account. Okay.
Correct.
So let me read this. Okay. So this guy says, thinking of investing in unit trust in Malaysia. Where do I start? About me, 40 plus male, working as an admin, PJ Mari. Current monthly, 2,000 ringgit. I'm thinking of investing in unit trust. This is my first time learning about unit trust. So my apologies if you have read this too often. I'm asking here because too many blogs and YouTube videos focus on hype and gimmick than actually giving advice. So hope you can help. So my questions are, is 1,000 ringgit enough to start investing? Number 2, any good article on investing in unit trust? Number 3, what sort of qualities should I look for in a broker? Number 4, what issues or questions should I discuss with a broker? And how do I discuss my personal goals with them? Number 5, which investment bank do you highly recommend? Number 6, what other advice I should know from your personal experience? I might start investing by next year. Hope you can help. Please. Thanks. So, I mean, from the outlook of this Redditor, it does look like they are coming from a position where they want to find out more about unit trust, which is very, very good start, I think.
Yeah, it's a great start. Yeah. So maybe I'll start off with the first one, and I'm not to be. I try to be as concise as possible. 1,000 is enough to start. Yeah, perfectly good amount to start. Good articles in investing in unit trusts. Ironically, this rather than an article, what you may want to do is, I know it sounds cliche and nerdy, open up a prospectus, a fund prospectus. Now, where to find it? Any bank will do. Affin Huang la, Public Mutual la, whatsoever. I know there's going to be a lot of jargon. I know it's going to be overwhelming, but I want you to look for this thing, this Redditor. Look for what we call the fund objective or the fund theme. Is usually in the first few pages. This fund will invest in Malaysian small cap or Malaysian large cap, whatever lah, or invest in Asia Pac equity, whatsoever. Read that. And then from there, you start Googling what does it mean. Google the terms. Now you've got ChatGPT. Fantastic. Ask the questions in ChatGPT. And then, here's a tip for those who are beginning to come into finance and investing and they find it complicated or any field, right? Just say, explain this term like to a 5-year-old. ChatGPT will actually oblige, They will simplify in layman terms for you, okay? So rather than an article, I suggest read the raw source, which is the fund prospectus, okay, or a fund annual report. If you cannot find it, it's because most websites are so lousy at putting it that because most people don't know where to find, right? Yeah, but it's actually not that difficult. Just look for a fund name, or you meet a broker. Actually, you shouldn't use the word broker. Meet a unit trust agent. Get them to give you the links. It's their fiduciary duty, okay? What sort of quality should I look for in a broker? Now, that's not the correct term. A broker is usually for stockbroking or a dealer. So if you're buying and selling shares, yes, you're looking for a broker. But in the case of a unit trust, what you're looking for is a unit trust agent or a financial planner. Now, there's a big difference in between the two. I'm just going to make it very short. Unit trust agents are usually tied to one unit trust company. You cannot have two. So if you are representing Public Mutual, only Public Mutual. You're representing Affin Huang, only Affin Huang. Or UOB Kay Hian, or whatever lah, you're only representing one. So obviously, if they're only representing one, they will say all their funds are the best lah. Logic ma, very simple ma. But if you're a financial planner, you are actually licensed to take in all and everyone. You can take principal, you can take Affin, you can take Public Mutual, whatever. And the right term is either a unit trust agent or a financial planner, okay? Licensed financial planner. What are the questions or issues I should discuss with the broker, and how do I discuss my personal goals with them? Telling a unit trust planner, usually they may not have the necessary tools or skills to help you design the whole thing. This one, you need a financial planner, right? The unit trust agent will be able to say, hey, you want to hit this objective? It's a very, very simple calculation. You can do that also on your own. You want, let's say, 1 million by 50. I think it's a bit tough with only 1,000 ringgit to start. I'm just being very honest. Because let's just say it's 60, right? Unless you increase your income, put in more contribution to hit that 1 million, it will take a little bit more work, put it this way. And math don't lie, right? It's compounding, and right. If you want to discuss a holistic financial plan, look for a financial planner, licensed financial planner. He or she should be able to sit down with you, map out your entire thing, not just your investment goals, your wealth protection, estate planning, all that kind of thing. Okay. Fifth, what investment bank do you highly recommend? Actually, for me, I don't really look at that as a main criteria. It's more because all this is branding only, right? It's like Colgate. But if someone came out with a better Colgate or better Dali or better Milo or whatever, right? It's the taste, it's the inner nuance of it. For me, rather than what is the investment bank, I would rather change this question into what is the criteria of a good fund or a good philosophy of a fund that I'm going to invest in. Because if Bank A is the largest, but then all the philosophy all over the place, and it's not looking at the right sectors that are growing, right? Then I don't care whether it's a brand name, because it's not meeting a growing sector or industry. I rather have my fund objectives getting it right lah. Okay. Last, what other advice should I know from your personal experience? Upgrade your skills. I mean, as I told you, and I think Louis may or may not have gone through this experience. Start from the basics. I bought unit trust. I put in I put in extra money into my loan to knock off interest, but I never stopped there. I start learning, get to read. Never stop at that source, because then you stagnate. Then you take everything else as the Bible truth, which is not true, right? Which is not true. Because you see, right, to get to where I am, it took years and years of interest. Most important is interest and understanding. And you started at the right place, asking questions. But bear in mind, when whoever gives you free advice, right, I leave it there lah. There's no such thing as free advice.
It's true, and I think hopefully this Redditor will come across our video, and if you have more questions, you can reach out to John and I, and we can discuss your case a bit further. Okay, so I think we wrap up the episode today. Thank you so much, John. I learned so much from you, just like diving deep into unit trust. I think unit trust in particular is a product that I really wanted to discuss in this podcast, because of how misunderstood it is, and how little people pay attention to the details of how the fund is managed.
Yes.
Instead, they are comparing it to like wrong, asset classes, not even looking at the right things.
Correct.
So just going through every nuance that we can find in this episode. It's almost 2 hours long, I think now. You found some nuggets that you could bring back, and then decide for yourself whether you should invest in unit trust or not. We're not here to say which path you should go. It's totally up to you.
Yeah. So great. Thank you, Louis, for proposing this topic. And if you love content like this, subscribe to the channel, give it a like, hit the notification bell so that when new videos are out, you'll be notified, and share with your friends and family. Louis and I look forward to seeing you in the next video. Bye.
Thank you guys so much. Bye-bye.